The next slide talks about charitable remainder trusts, and what I want to do is to just bring to your attention that these CRTs, or well, basically a charitable trust, by structuring something of this nature, we have clients in many cases that have other assets that have appreciated substantially over the years and they want to dispose of them, but they don't want to pay the taxes. By structuring a CRT, or CHRT as we show in our materials, the husband and wife can get a significant income tax deduction, which reduces their income tax in the first year up to 6 years, and may, in many cases, provide the kind of funding that would allow for the purchase of some kind of a policy, whether it be life insurance or the long-term care policies. And in that kind of a structure, they also avoid all current taxation on the on the asset that has been put into the trust. Very important that you understand, if you're going to talk with clients about this, that the asset gets into the trust before any kind of an offer is made, if it's real estate or if they try to sell any kind of portfolio. You cannot do this after the fact, so be very careful in structuring it. You can also do it, this is not known by a lot of people, I guess, but a husband and wife, as well as say they had 3 children. 3 children could be included with the parents, and in that scenario, until all 5 family members had passed away, the income flow from that would continue, and it would continue year after year without exception. The trustees of the trust are the husband and wife initially, and then the children can be trustees. They do not lose control of the money. You have the opportunity to become the investment manager.
Bill, I think that's really great for the simple reason that one of the big problems we all have is finding the premium dollars. And this is a way of finding the premium dollars and at the same time doing something for the philanthropic organizations you care about.
Precisely. You can see in the next slide on page 81, this is figure 10.6. This is exactly what Bob is talking about. We've all of a sudden found the income. An 8% payout is $80,000 a year on $1 million. Each year, that can adjust depending on how the document is written to reflect increases in value in the trust assets, so that they can see an increasing income in the years ahead. And as I point out, the children can also be a part of this. The funds going to charity are set by IRS guidelines and can be substantially less than the original amount that was put into it 30, 40 years in the past. So you can see there are a variety of ways of solving this. The tax deduction, as you can see in this situation, could buy a survivorship life insurance policy, which could replace the asset given away, possibly to the children or grandchildren of the husband and wife who've created this kind of a trust. We also have policies out there in the marketplace which insure 2 insureds on 1 policy. It's an unusual situation, but it does provide some opportunity to take care of situations where you have possibly a second marriage and there's a wide difference in ages, and there can be inflation included in it, and it also provides a death benefit. This next slide, page 83, is very, very important. It talks about the structuring for a C corporation, and it's unique in terms of the way the Congress and the taxing authorities have allowed this to be created. As far as I know, it is the only fully discriminatory benefit available that is fully deductible to the corporation. It is not reportable on the executive's income tax return, and you'll see in the next line it says benefits to executive and family income tax. The word free has dropped off there, but it's income tax free. As to benefits, no reporting of the premiums paid to the executive, and the policies can follow the executive into retirement. There are, in some cases, return of premium riders that can be available. Now keep in mind, these are long-term care policies we're talking about that can be funded and paid for by the corporation 100% for the executives and their families. These are not life with long-term care, because those would not be income tax deductible. You can pick and choose the executives with all of the benefits above, and you can have different benefit levels. You can also do a group plan. And I would point out to you, as far as a group plan goes, I did one just a few years ago for a client that had 16 employees. And this was a guaranteed issue, group product, and the day he gave me a check, he was instantly qualified for approximately $450,000 of long-term care benefits for himself and the same for his spouse and his children, his adult children. And when he gave me the check, he was sitting in a wheelchair. And I can assure you, he was thrilled to be able to find something like this available to him under those circumstances.
So, Bill, really in this case, the man already was really qualified to receive long-term care benefits, and yet he was able to get a new policy because it was guaranteed issue? That's remarkable. I just want to throw in another comment. Sometimes, even if you're only dealing with individuals, it's worth asking them if they have a C corporation. Sometimes you'll find they do, and if they can get their C corporation to pay for their own personal long-term care for themselves and their wives, that makes it 100% tax deductible. We found that in a few cases.
And that's exactly what happened in this group case. And even though it was a group policy, I called the insurance company and explained the circumstances before I wrote the contract. And they very clearly said that they could not challenge this situation because they had a shelf-registered product in the state of California, and they did have to follow through on it. The representative, of course, holds stock in the company, and he begged me not to do it, but he said there's no reason you can't. So the client was fully satisfied with the product, and if he was to shut the corporation down, the individuals would be able to take their individual certificates and continue that coverage as long as they paid the premium for the rest of their lives.
Somehow I don't think that $450,000 of benefits was going to cause that stock value to go down, Bill.
I don't think so either. Moving on to Chapter 11, which is the chapter concerning IRA distribution planning. We point out several things in this chapter just to try and round out this subject. I had a great deal of help from Ed Slott's group completing this chapter, and this is page 87. There is another slide on page 89 I think you should be aware of. I don't want to get into a long discussion about that. That in itself could be several days of discussion. But getting into this area does open the door to some very, very large cases and opportunities you otherwise wouldn't see. So it may be a chapter that helps you with some of the work you're doing. Moving on to Chapter 12, this is page 107. We're just trying to show here what proper estate planning can do for people. And of course, these are famous people. But I found it interesting when you get down to people like Elvis Presley, who of course has passed away, but many people feel has not. The net estate costs, the settlement costs, came to almost 73% of the estate. You might also notice further down that Elwin Ernst, CPA, had a very substantial amount of tax, 56% of his estate. So this is just a slide to enter into a discussion about estate tax planning, which really is a subset of long-term care planning in reality. You may look at it the other way around, but it does depend. This next slide on page 111 does show how a charitable remainder trust does work, and you can see in the slide, the figure 12.5, how we discuss the use of a CHRT, as we call it, or a CRT versus not using one, what the benefits really are, and this was just an average case. We do an average of one to two of these a month during certain times when people all of a sudden are trying to bring down their tax liabilities. This page 153 I have found valuable because it addresses directly this entire issue of the C corporation tax deductions. This information was current at the time it was written. We had several CPAs look it over. We checked all of the regulations as were available, and under the rules that this information can be given to a CPA, and I think it will help you reinforce with that CPA your knowledge base on this subject. As you might know, different types of corporate organizations have different tax consequences, but a C corporation really is the best of both worlds in this area.
I might just comment that if almost any other kind of business structure, S corporation, LLC, partnership, sole proprietorship, will get a deduction, even for the top people, based on those amounts that Bill showed on a prior screen. In other words, the amount that an individual can include as part of their medical expenses in determining whether to get a deduction or not. With that kind of a business, a non-C corporation, that is just fully deductible. So I just thought I'd throw that in.
Thank you, Bob. This next slide comes back to something I said when I first started this webinar today. This is called a long-term care insurance waiver form, and this of course goes back to the days of the disability forms that were used. And the reason that you see it as a color is because we put it in orange. I'm going to tell you a little story about this. I created this because I had initially created a case in which two people had decided to buy coverage, and by the time I got the policies issued, here in California you have to give them, with the application, you have to give a check for 1 month's premium. I had found out through one of the sons that the clients had decided not to buy the coverage. So I sat down with them and explained that how the policy worked, what the benefits were, and they politely said they did not want to buy it. And I said that was not a problem, and they were quite surprised that I was backing off so quickly as opposed to trying to push them into buying something. And I put this sheet in front of each one of them, and I said, please read this information, sign at the bottom, and date it, and then I can get your money back from the insurance company. Well, of course, I could have gotten the insurance company to refund the money without the form, but I was simply reinforcing and protecting myself from a future claim, potentially from either one of them, for not understanding the issues. They started to read down through it. One of them immediately said they would not sign it, and I fully understood that, and I said that's not a problem. I said what I'll do is I'll sign down here below where it says client declined to sign, where it says agent. And I said I'm going to put in the date and the time, and they said why would you do that? Because they were just curious that I was doing it this way. And I said, well, in my computer system I have a record that I had an appointment with you today. I said probably 10, 15, 20 years down the road, as you get older and you do have claims, I want to be able to find this sheet, and I have made it an orange sheet so it stands out in my file, so that when your son comes by with his attorney and tries to file a lawsuit concerning this issue, I can pull this out and indicate very clearly time, date, place, and also the supporting information that we provided to you when you decided not to buy this. Now, as I got to the end of that statement, there was a slight smile on my face, and I simply said, would you still not like to sign this? And basically what they said was, we will buy the policy, because they knew that I cared about them enough that I was willing to stand up to their objection, and because I was absolutely determined that they understand the issues involved in this very serious future liability, they bought the policy. I used this form and successfully closed 60 to 80% of the cases where they initially say they won't buy, because they know they cannot walk away from me and legitimately ignore this kind of future issue.